Ladies and gentlemen, good evening and thank you for tuning in. This is Christopher Aaron. It is the 22nd of November 2017. We will be focusing on the US dollar in this broadcast. Some of the technical signals that are shaping up that continue to paint the picture that the US dollar has formed a multi-decade top. And thus far, over the last several months that we have discussed this every so often, it's been really an academic type of exercise. We've been looking at it on the charts. We've been seeing this develop. But there is going to come a time when this is being discussed on the mainstream news. And I would like to think that you heard about it here first. There are going to be politicians coming out. My prediction is within the next 5 years, there will be politicians coming out talking about the weakness in the dollar. How do we stop the dollar from falling? What do we do? What laws do we need to enact? What does the Federal Reserve need to do? But we are looking at it here from a technical basis, and that is the point of this channel. There have been a lot of people who have been discussing the value of the dollar, that it was going to fall over the last 10 years, but it did not fall. It kept rising and rising and rising. So that's the purpose of this broadcast, which is to not just repeat the fundamentals, which sometimes can be right, but the market can just wait for 10 more years to start falling from when these people were talking about those fundamentals. So we want to actually see, when is the market confirming some of those things that are taking place beneath the scenes. I do want to mention very quickly, as we look at the price of gold and silver here, I do want to mention very quickly that I have a relationship with a dealership that is located in New York City called Bullion Exchanges. They will give you $10 off of your first order of $300 or more. There's a link below. You just click on the link and use the coupon code. If you have another dealer that you like, absolutely stay with them. I just want to offer this to people to try it out for the first time. I know the owner of the dealership in person. I've visited the dealership. I've seen their warehouse. I've seen their shipping department. I like these guys. That's all I'm saying. If you want to give them a try, the link is below. Looking at the price of gold, this is excellent technical action. This really is. Someone sent me a message a few days ago, and they said, when is the last time that you've seen, not necessarily with gold, but with silver, when is the last time that you've seen this up and down, violent? We have these moves, $10, $15 up one day, $10, $15 down the next day. And yet, as a net sum, we are not seeing very much change here over the course of the last several months, right? And you can see that on silver. When is the last time that we've seen that? And this is very unscientific, but the time that comes to my mind as an observer and a student of these markets for the last 15 years was coming out of the crash of 2008, when silver was just trying to get above that $10 mark again. And every time it would get above 10, someone would smash it back down by 20 or 30 cents. And then it would get above 10, 10.25, boom, smash back down to 9.85. So we're seeing that happen here in the 16s and low 17s. This looks like it is basing price action to me. Basing when? After a significant decline out of 2011. So all things considered, when a market is moving sideways after it has been falling for a number of years, that tends to represent a bottom being put into place, from which the new market, the new bull market, will be developing over the next couple of years. And this is going to be a significant part of the reason why we're getting into this now. The technical posture of the United States dollar. Let's update this. And there were a lot of people, when I was talking about this a year ago now, and we were looking at this top right in here, late 2016, early 2017, and I was saying, guys, this does not look good to me. Something's wrong with this advance. Something's wrong with the strength of the dollar here. A lot of people were doubting that call, that macro call. And look, I don't get everything right, but I do get a number of things right. And this was one of those things that I was really sticking with at the time. So we're looking here at the dollar over the course of the last 30 plus years. And this is the monthly momentum indicator for the dollar. By the way, if my voice sounds different, it's for two reasons. One is because I'm just getting over a cold. And the second reason is in packing for my Thanksgiving travels, I forgot that little foam thing that goes on the microphone. So sometimes little things like that can change the way that it sounds on a broadcast. So the dollar monthly momentum indicator. And we were looking at this, and this is the big picture here, why I'm so bearish on the dollar. Overbought signals. So what are we talking about? Above the chart of the US dollar, we are looking at a momentum indicator. How fast is the dollar rising? How fast is the dollar falling? That is what momentum is indicating here. The dollar in the early part of 2015 was the most overbought that it had ever been in over 30 years. The most overbought that it had been, and then we saw a nominal new rise above the previous peak. So 2 years later, a nominal new rise as momentum was failing. And I was saying something is significant about this. So I went back and I studied some of these examples from history. And sure enough, it turned out that this signal, this technical signal, a study of momentum in the dollar market, showed that the last time that the dollar had been this overbought and then made a nominal new high within 2 years was the peak in 2001. After that, the dollar entered a 7-year declining phase. It lost over 40% of its value versus other foreign currencies. This same signal appeared again in 2015, except with the caveat that this signal was more overbought even than it was in 2001. So there were a lot of people saying, well, we're not sure if that's going to work out. We're not sure how reliable this signal is. And we were looking at other things, though, at the time. This is the big macro picture. So the big macro idea here is to say that if this signal is setting up again, we may be looking at another 7-year decline. So this would take us, the most important point is that this would take us into 2025, and it would take the value of the dollar off the chart on the dollar index. So in other words, it would be the lowest value for the dollar going back over 45 years. This is what is setting up from the big picture perspective. When we zoom this in to this last period here, and here's how I was dialing this in at the time. We were looking at this period here from 2004 through 2015. We had this breakout above this level here, 92, 93, a breakout, a consolidation, and a final breakout here that a lot of people at the time were saying this represents a continuation move. The dollar is moving higher and higher. And when I saw this first reversal back down below this resistance zone here between 99 and 100, I said something is wrong with that. That does not look good to me. A market that has just broken out of a 2-year consolidation should not come back down to retest that breakout point twice. And let's zoom this in one more time here. You can see what I mean. Here was that consolidation. Here was that breakout. And I was saying at the time, we see these 1 retest, 2 retests. This is when something shifted in my mind. A lot of people were saying, no, the dollar is going to keep going higher. I said, guys, I have a different model. We study momentum. We study resistance zones. We study trend lines. We put everything together and we try to come up with a best picture analysis on what is happening. So let's bring it back to the present. Where are we right now? The dollar has indeed formed what appears to be a false breakout above this consolidation zone. You can see this very clearly, this consolidation here between 92 and 100.5, up, down, up, down, up, down. A false breakout. A false breakout is the most ominous technical signal you can observe when it occurs at a multi-decade high. And this is exactly what we've seen here in the value of the dollar. Now, when a false breakout occurs, for example, at after a move of 1 or 2 years, or a false breakout from a short-term trend line, that is much less significant. But here we are seeing the false breakout after a multi-decade high. This 2-year consolidation, false breakout, failure to hold it. Sure enough, boom. Over 6 months, the dollar comes back down to this critical support zone. So what can we say now for the dollar? If you put everything together, what I've said at this point, momentum was the most overbought that it had been in over a generation. A false breakout. We have a new linear trend line developing here on the way down, and we see continuous cracks in this critical support zone. We're calling this now a 3-year support zone. And notice, every time the dollar is touching this support zone, look here, it was lower than the previous lows. Here in 2016, lower than this low. Here in 2017, lower than these lows. These are what we call cracks, technical cracks. And when you're seeing this after such a long consolidation, this is just another one of those technical hints that something is not right here in the value of the dollar. And then you have to say, well, if this is happening to the dollar, and this is still, for all practical purposes, we're still in the region of this multi-decade high. And I see a lot of people coming out now and saying, well, the dollar has fallen too far. It needs to revert to the mean. As if any market needs to do anything. And they're referring to a mean of the last few years. If you were to look at a mean of the dollar for the last 20 years, it's a lot different picture. I'm still saying this is a long-term top. The dollar does not need to revert any higher. This is representing a very ominous long-term signal. So the question is, if we accept that this was a long-term top put into the value of the dollar, and you've got a new downtrend forming here, a visible downtrend is forming. This is not fundamental analysis about the Chinese investors dumping their assets or Japanese investors refusing to buy treasuries, which is what the fundamental base analysts said over and over and over again over the last 10 years. We are talking what is actually happening in the market here. And there is a new linear downtrend that's formed in this market. And linear analysis gets a very bad name in technical analysis. I do not know why. Let's zoom this in one more time. And you can see the clarity of this new downtrend. 1, 2, 3, 4, 5 hits on a same linear downtrend. Is it any wonder that after this last hit, the dollar, has failed, rolled over again, and is falling once again? So these linear trend lines are very powerful. No form of analysis is perfect. But when we mesh this together with support and resistance zones, and we look at Fibonacci's as well, and we look at momentum and we look at ratios, we look at all these things combined, you can know something about these markets. And in this case, we're talking about the US dollar. This is going to be very important. You know, again, I think there's going to be a time where politicians are coming out and are attempting to make laws to stabilize the value of the dollar within 5 years. And people will be pointing fingers at one another. Who did this? You know, do we blame the speculators? That's usually the first scapegoat that is given. Do we blame the Chinese? Do we blame the central banks? Do we blame the oil companies? Who do we blame? The dollar does not look good. The big question here is, does this linear trend line hold for right now? If so, within the next few months, you can see how this is coming downward. Within the next few months, we are going to see the dollar break through this support zone. We've already seen these cracks below 92. But if this trend line holds, we are going to see the dollar plunge within the next 12 months. And this is absolutely perfect timing because the sentiment in the precious metals sector is fairly bad right now, especially in the United States. People are forgetting about it. Most people are not interested at this point, judging from retail demand. We can see that. But if this occurs here, if this breakdown below this support zone between 92 and 93 occurs here over the next few months, we can see when it would happen if this linear trend line is going to hold. If this trend line breaks, it does not mean the entire thesis is washed away. This false breakout still super critical, ominous technical signal. It just means that this is going to take longer to play out, according to my study. So we'd be looking at some sort of bounce here in the dollar to last into the first part of 2018, and then we should see it roll over. Under no circumstances in this technical model should the dollar recover this resistance zone now between 99.5 and 100.5. So my best guess is if the trend line were to break, the dollar would roll over somewhere here in the middle 90s. This will be very interesting to watch. It's going to be basically a judgment. We're going to see, is the dollar going to really pick up momentum to the downside? Is this going to happen over the next couple of months? Or is this going to wait until later in 2018? We're talking about that. There's the big picture perspective again with the dollar. We have multiple technical targets for 3 years, going out 5 years, going out 10 years. We'll look at all those at another time. This is what to pay attention to now in the value of the dollar. So what is not coming off of a multi-decade high? It is the commodity complex, which conversely is at a 40-plus year low. We're talking about an average of 19 different commodities here at this point. Down below, we look at gold versus the commodity complex and silver versus the commodity complex. We can see that since the mid-2000s, gold and silver have been outpacing the rest of the commodities. Last time we had a major breakout like that was in the worldwide financial crisis of 2008. Thank you very much for tuning in. And we have a picture of Ray Dalio up here for a reason. I will get to that in just a moment. Little sentiment indicator. Ray Dalio, just so you know, is one of the largest. He is the manager of the largest hedge fund in the world, Bridgewater Associates. Myself here at iGold Advisor, we produce a premium weekly research product that comes out on the gold and silver markets. We also cover the GDX and individual mining equities, the ones that we are investing in here, as well as the exact reasons why, all the fundamental and technical research to back that up. I also work with individuals from very beginning stackers in the precious metals, to traders who are looking to leverage their gains either in the mining sector or using other futures or options. You can find more about this on the main website. Why do we have Ray Dalio up here? Very interesting article here that came out in Bloomberg last week. The largest hedge fund in the world increased its holdings in gold by over 400% in the last quarter alone. 400% increase in one quarter. So this brings his holdings in gold to over $600 million. This is not your typical gold bug. And no offense, I'm just saying from a big picture perspective here, this is not your typical gold bug. And the quote that he has given recently is to say that I think that if individuals have not already done so, they should consider moving 5 to 10% of their portfolios into gold. Why is he doing this? Probably because he's looking at his own models of the US dollar. He's probably not looking at the exact same models as I am, but I'm sure there's some overlap there. And he probably sees the potential for a loss in the value of the dollar. So he's moved almost $500 million into gold in just the last quarter. Now, if the largest hedge fund manager in the world has done this here in late 2017, but we see retail demand here in the United States, in other words, the mainstream investor is at 10-year lows. Very interesting. They use this word, this phrase, smart money, sometimes to refer to insiders or those with high-powered money who have a almost unlimited budget for research and analysis. And if this does not fit that description, I do not know what does. Meanwhile, we see the average person completely ignoring the precious metals at this point. Not only the average person, but I would say the person who has believed in the precious metals for the last number of years. We see a capitulation type of sentiment right now amongst most precious metals investors, except for the die-hard investors. And if you're listening, you're probably one of those. I get to see some statistics from readership of articles that I publish, readership from other sites, interest in various keywords, etc., etc. And I can tell you that interest has dropped off here as the prices of the metals are consolidating in an extremely healthy manner. And we have individuals such as this moving massive chunks of liquidity into the gold market. You couldn't ask for a better setup at this point. But once again, this does not mean that the prices are going to skyrocket this week or even at any point in the remainder of this year. But the base that is being built right now is the most healthy pattern that you could possibly ask for if you're a long-term investor. And I think very good things are lying ahead for the next 12 or so months. So, of course, the time to build the ark is before the storm comes. I do thank you for tuning in. The premium research service that's going out this month will cover analysis such as this on everything relating to gold and silver, US dollar, commodity complex. We will look at the Japanese yen to gold ratio. We're seeing a shift in that ratio. We will look at the US bond market as well. Very important things happening there. And we cover all the individual miners. So have a lovely Thanksgiving if you're in the United States. If you're not in the United States, enjoy the break that this holiday gives from the markets. And I'll see you this time next week.